Hi there Internet, it is Friday the 26th of March, and that means it is time for my Friday update. Let's take a look at what has moved the markets this week. Okay, just a quick note. I have been trying to communicate with my copiers daily on eToro. I've definitely been doing it a lot less, and that's because I'm in the process of studying for and becoming certified. This is part of a requirement for popular investors at my tier on eToro. I think this is an incredibly good thing to do. It'll give you more confidence in my capabilities within the investment and wealth management industry, and the certification is internationally recognized. The bit of a bummer is that it's supposed to take me 426 hours of study time to complete this particular diploma. My plan is to do it in half or less than half of the time, but that means that it's a huge draw on my time at the moment. Don't be too concerned by this. Managing the portfolio is still my #1 priority, but this has become my second priority at the moment, and communication with you, my copiers, is unfortunately now third below this. I want to get this out of the way as quickly as possible so that I can get back to creating videos and talking to you about the markets and my strategies, which is something I really enjoy. Okay, so in terms of the market, it has been a rough week, and it's pushed the portfolio into negative territory for the first time this year. Well, for this month at least. We're still positive for the year. I don't think this is the end of the world. Within any year, we're likely to see a few red months. As long as we have more green months than red months, then everything is a-okay. My benchmark, the S&P 500, has lost a little bit this week, but less than I have. So the S&P 500 is now 4% year to date, whereas I am 5.4%. So I'm slightly ahead, but my goal is to beat the S&P 500 by 20% in any year. So I've got some ground to make up. But I think the actions that I've taken during this week will definitely help us do that. All right. In terms of returns on other timeframes, you can take a look on my website, gettingrichlowly.org. But if you invested $10,000 or pounds with me in 2015, 6 years ago, you would now have a return of 71,000 pounds or dollars, which is pretty fantastic. So through this week, there have been a few different things that have happened that they've hit certain areas of my strategy. So I have a strategy made up of smaller strategies, and some of those strategies have been hardest hit. You will have seen me buying quite a lot through the past few days. I've spent by far the bulk of my cash now, so that we can take advantage of some of the movements that we've seen through the past week. There have been incredible opportunities created through the sell-off. So one of those strategies is the UK recovery, and something that has been driving the market. And so we can see it in the popular headlines on the Financial Times. It's all about vaccines. So the UK and the EU are fighting about vaccine supplies. That seems to have been resolved. There are fights within the EU about vaccine supplies. Countries within the EU are fighting with each other. There's a second wave of coronavirus that's hit India, and India has, I think it has the largest or second largest vaccine creation capability, and it said, we're not sharing with anyone for the next 3 to 4 months. So these tensions have hit recovery stocks, and also oil, the price of oil, which in turn hits the price of energy stocks, even if those energy stocks have very little to do with oil. So some of the green energy stocks, as an example. So the wider sell-off tends to catch lots of things in its wake, and that's where all the opportunities are created. Coronavirus cases have been creeping up across the EU, India, and parts of the US, and this has meant that people now realize that international travel is not going to happen as soon as we had originally anticipated. And so the sell-off in things like airlines makes sense. EasyJet and Ryanair, for example, instead of seeing huge revenue, let's say 2 to 3 months from now, that's now been pushed out by another quarter or two. So there still will be a recovery. So if you have bought good travel stocks, solid companies, they will be able to survive and they will thrive, but it's going to take a little bit longer now. However, I did see this as a risk initially, and so some of my stocks like JD Wetherspoons and National Express, which are companies that only rely on UK business, I think they are very well positioned. They've sold off through the past week, so we've gotten better prices, but the UK vaccine rollout still seems to be going quite well, and I think our domestic recovery will be one of the best in the world. All right, so next up, Chinese stocks are part of our portfolio that have been hit hardest. So if we take a look here at the 1 week performance, these are Chinese companies listed in the US, and they have taken a pounding for several reasons. I'll talk about them soon. So Baidu, Chinese, Qdian, Chinese, NVIDIA is part of ARK, so that's a whole other story. Zepp, Momo, Douyu, Neo, Invesco, China Technology, ETF, these have all been hard hit through the past week. Now, the first thing to note is that all of these companies are rock solid. Even before the sell-off, even before Baidu was 20% down, in terms of valuation, it still looked like a company that I wanted to own and buy. And so I did. And we've been accumulating bits and pieces of stocks in these companies on the journey down, and I'm fully confident that these companies are going to give us great returns over the next years and decades. So what are some of the things that have moved the Chinese markets? Oh, there's just so much stuff that's been going on that has smacked sentiment for Chinese stocks. So the US and China, they continue to fight, but they continue to be very reliant on one another. The US needs China to buy their debt, right? They need them to buy their bonds in order to fund their operations. A lot of US companies are heavily reliant on Chinese companies for their supply chains. And this has impacted a few different topics for the week. I'll touch on those in a moment. Jack Ma put his foot in his mouth, which meant that the Ant IPO was pulled, which affected the Alibaba stock price, which accelerated regulation of the of anti-competition, or accelerated anti-competition reviews within China, which has further affected the Alibaba stock price and other Chinese giants. So we're now seeing the potential for fines and restructuring of the mega caps within the Chinese market, affecting Chinese sentiment. The Ant IPO has been delayed. That company needs to be restructured. The value of that company is probably won't be as much when it does eventually IPO. On top of this, we are also seeing just this week the announcement of regulation of consumer data in China. So there's a new body that's going to be formed, probably using some of the people from the bigger internet giants in China. And this regulation on consumer data means that there'll be some cost impact to the companies that benefit from that data at the moment. The good news is that the consortium that's going to be created will be made up of those very companies. Again, this is very good for the maturation of China and for the people within that economy. But there will be some temporary costs to the businesses involved. If we look at this ETF, which is a wrapper on the CSI 300, which is kind of China's S&P 500 equivalent, we can see that there was a fantastic bull run through last year, and then the beginning of this year kind of spiked through this year, and since then it's been selling off. So in any kind of ramp up, we should expect a consolidation. This one has been severe, and this has been for a few reasons. The Chinese market is maturing, so I've mentioned some of the regulation that's come about and will be coming about soon. That changes the way that businesses work, and while those businesses are adapting, there's a cost impact to those businesses. Other things that have happened is that Chinese growth has been fueled by debt, like many countries around the world, and some of that debt has been risky, so the government has been trying to rein in this risky debt, which has reduced liquidity in the market, and there have been a few hiccups in the operations of the market that have scared investors. On top of this, Chinese companies and US companies are tightly bound. I mentioned a little bit about bonds and the supply chains earlier on, but this means that when something negative hits the US market, like bond yields rising, that has an impact on the Chinese market too. And obviously China and the US aren't on friendly terms, and this has manifested in a few different meetings and comments and headlines between the two countries. There are sanctions that have been imposed on China, and China has returned the favor on the US and certain other companies. And all of this is played out during this decline. Well, a lot of it is played out during this decline. So that has meant that instead of this just being a natural correction, this has been pushed much further south and has threatened to enter bear market territory. I think we've stopped just shy at I don't know what it is, 16-17%. But what we need to bear in mind is that Chinese GDP growth is targeted at 6% this year. It's seeming quite likely that they will overshoot. The companies that have sold off quite heavily that I own are rock solid companies. They're very good at what they do, and they have enough money to weather any kind of storm. And so I think the stock market valuation and the underlying company valuations have become decoupled. And that's fine. That happens from time to time, and that's where the opportunities are presented. So this has hurt our portfolio because we've been buying Chinese stocks, accumulating them through the past 2 quarters. And there's been a big sell-off, but I think through the next year or two, they're one of the biggest growth engines. They'll be one of the biggest growth engines for the portfolio. That's where we will see our double-digit and triple-digit gains over the next couple of years. Okie dokie. So in terms of the rotation, this has kind of fallen into the background a little bit over the past week. It has kind of continued. So if we look at the month-long performance, we can see definitely that value and defensive stocks have been the biggest beneficiaries. So value stocks, we don't hold a huge portion of them in the portfolio. Well, deep value and consumer defensive stocks, they form maybe 10% of the portfolio. I do have another section of stocks that I call growth value, and these include things like the FANGs, or the cheaper FANGs at least. And if we look at the 1 day or maybe the 1 week performance, you can see that through this sell-off through the past week, the FANGs have held up quite well. And I expected this because while other speculative or more risky tech has been selling off, these big companies are very likely to continue growing through the next year, decade, 2 decades. And so money is looking for safety in these broad sell-offs, and it's finding its way into the FANGs. So deep value stocks, consumer defensive stocks, and the FANGs have helped cushion some of the blow that we've seen to our other strategies through the past week. But I fully expect those strategies being Chinese stocks and UK recovery stocks, to outpace these in the next 2 quarters. All right, in terms of oil and energy, the oil price has been highly volatile. So initially it looked like there was going to be a supply glut because the world is opening up slower than anticipated. But then a really, really big boat got stuck in the Suez Canal, and that boat is blocking just about anything getting through the Suez Canal. I think they've got a secondary channel, and they've got some smaller things that are able to get through that way. But right now, oil supplies and other supply chains are massively affected by the ship that's blocking the Suez Canal. The cost of this is estimated at something like $10 billion a day. They've been trying to get the ship unstuck for a while, and worst case, it looks as though it might be there for weeks. So we're seeing oil prices initially jumped when this happened, and then they pulled back. I'm not sure exactly why, but oil prices are up again today, and there have been some big fat green candles. I think not yesterday, but you can see the massive volatility that's going on in oil right now. This, as I said before, this affects energy stocks and some energy stocks where it really doesn't make sense. So the likes of some solar stocks have looked quite attractive. In particular, Canadian solar, which is cheap by just about every single valuation metric out there, just posted excellent earnings. So I've been loading up on those a little bit more. The chip shortage continues. It's getting really bad now. I think globally, the cumulative loss in sales to the auto industry is estimated to be around $61 billion through this year. It's affecting primarily the automakers at the moment. And what's quite interesting is that China could probably undo the supply shortage for automakers if the US were allowed them to do it, and they could do it quite quickly. So that's a strong bargaining chip for China. I'm not sure if the US is going to allow that, but I'll keep an eye on that in the coming weeks. What we've also seen is Intel is going big on its capabilities to make chips within the US. So silicon and microchips, the demand for them is only going to grow as time goes on. So robotics, AI, all trends that are going to grow through the next few decades, all the different things that we need to power, they all require microchips. And at the moment, Asia dominates that market by a huge, massive margin. This makes the US uncomfortable. Ramping up the ability to create chips and become an industry leader is something that would take decades. And we've seen Intel make this statement, and they've committed to $20 billion in investment for the fabrication of chips. The US government at the moment is reviewing the supply chains, particularly in this area. They don't want to be super reliant on Asia. So I expect the US government is going to back Intel in a big way. We're going to see some announcements, I think, in the next coming weeks and months about how the US is going to go big on their investment in Intel. So I expect Intel to do very, very well through the coming years. Setting up this capability is going to take them a few years. It's not a short-term play, by the way. But I think that they, as a company, are just going to grow for the next decade or 2 decades. Okay, so that's about it for this week. There are other bits and pieces of news that have moved the market, but I think those are the big ticket items. So in terms of what will move the market next week, I briefly mentioned that China's GDP is expected to grow by 6% this year. So this is the thing to keep in mind through all of this bad news that we've seen through the past week. It is expected that all the major economies through the next year will grow massively, as well as through 2022. There's going to be enormous GDP growth. So these little things that happen through the year that move the market up and down, there's always something that affects the market. It happens every year. And at certain points in the year, we find that there's a confluence of bad information, and it forces the market to really tank. Don't worry about that. Sit back and look at the bigger picture. The US jobless claims in the US have now hit a low. This means this is another indication that the US economy is powering up. So last night, the president gave his first press conference. He increased the vaccination target for his first 100 days in office, and he said that he expects the US economy to expects GDP to grow by at least 6% through this year. So what we have is a picture of a world where there have been issues with the vaccine rollouts. There are always going to be issues with the vaccine rollouts. It's meant that some of the plans have now been pushed back by a quarter or two, but those plans remain. The things that we thought we would achieve, we will achieve them. The time frame is just different. Global GDP is still going to grow by a huge amount, not just through this year, but also through next year. The stock market might become uncorrelated from GDP growth for a time, but over the long term, it always becomes correlated again. So try not to worry too much about the short-term moves. I know that it can be quite stressful if you are watching the charts every day, all day, like I am, but once in a while you need to sit back and look at the wider picture. The Suez Canal is probably going to be blocked for a while. So this is going to be a headline item for a while. This is going to affect supply chains, not just for oil. So I think the oil price is going to continue to be volatile. Energy companies off the back of this will continue to be volatile in terms of their prices. It will become unblocked, but at this point we don't know exactly when. And lastly, so the earnings for UK and Chinese companies have been going on. There've been some good earnings and there've been some okay earnings and some bad ones. So Cineworld posted earnings yesterday. It wasn't great, but then again, who expects cinemas to have done well through the past quarter and the past year? But what we will see from next week is the beginning of US earnings. So I completely expect that the media outlets will start focusing their attentions on earnings. I think it's going to be a mixed bag, to be honest. So we'll have to see how that goes. If too many of the very large companies in the US post very bad earnings, worse than expected, we could see this send the market further south. Overall, I think we won't see too many poor earnings. It'll more be a mixture of good and bad between the different sectors. Okay, so all this bad news in the past week has hurt stock prices. It's hurt some of my strategies in the short term. I review these strategies daily, and I don't think any of the fundamentals, the plans behind the strategies have changed. Just some of the timelines have changed. Some opportunities have been created in the sell-off, and so I've been accumulating stocks to bolster those strategies. And when they come into play, it'll be time for liftoff. All right. I hope you have a great weekend and a great trading day, and I will talk to you next week. Goodbye.